Hello. This is a synopsis of chapter 11 in the textbook. And when I went through chapter 11, I didn't find the PowerPoints to be quite as helpful as in past chapters. So I would rather just give you a synopsis of what to concentrate on in that chapter and what the main takeaways are for that chapter. So after you watch the synopsis, then I would still recommend go in there and read the book and also take a look at the PowerPoints, but look at this first. So before you take the quiz, make sure that you understand the economic indicators, what types of economic indicators there are, leading and lagging indicators. Make sure you understand inflation and deflation. Make sure you understand what monetary policy is, and make sure you understand what the Federal Reserve is, what their purpose is, and monetary policy and fiscal policy. So make sure that you know all those things before you take the quiz. Okay, so let me give you a synopsis of the big picture and the takeaways of this chapter. So first of all, let's talk about the economy. So what the Federal Reserve was established at the beginning of the last century, because we used to have these financial panics and there would be these runs on banks and there would be a liquidity problem. So the Federal Reserve, which is not part of the federal government, the Federal Reserve is totally independent. The purpose of the Federal Reserve is to help the economy to be smooth. So if there is a credit crunch, if there's a lack of supply of money, they will infuse money into the system and vice versa. So the Federal Reserve uses what they call open market operations to manipulate the money supply to make sure that that the economy that money's flowing freely and people can get credit and so forth. And so when you hear that, oh, well, the feds have raised interest rates or the feds have lowered interest rates, that's the Federal Reserve using their open market operation system, and they're affecting the money supply to try to smooth things out. Because what we want is an economy that is increasing, but steady. So they want basically a straight line that's going up slightly. That's the best scenario. Of course, that doesn't happen. We have these ups and downs. When you think about the economy, we have these ups and downs in the economy. The economy is increasing. I mean, GDP is increasing and so forth. So our economy is getting better overall, but we do have these ups and downs. We have these expansions and we have these recessions. And so the purpose of the Federal Reserve is to use monetary policy to try to smooth these expansions and recessions out. There's also fiscal policy. That's the government. So monetary policy is the manipulation of interest rates to try to smooth out the economy. Fiscal policy is basically the government using taxes and spending to try to smooth out the economy. So I'll get to that later. So first of all, let's talk about the economy and what happens. So the economy typically is in an expansion phase or a contraction phase. Right now we're in an expansion phase. So what that means is GDP is increasing, gross domestic product, and unemployment is low. And so we are in this expansion phase. So you might ask yourself, well, why can't we just continue to expand? Well, what happens is when you have GDP increasing and unemployment that's very low, the problem is you end up with inflation. Inflation is simply rising prices. So think of inflation as this is the cause of inflation. It's basically too many dollars chasing too few goods. So if you think about Thibodeau as a closed economy, let's say we were all working 40 hours a week, making our salaries, and we're spending money, everything's going fine. And then production increases. The companies that are in Thibodeau start to expand. And so now we're working 60-hour weeks. We're making time and a half or whatever. So we're making more and more money as the economy of Thibodeau ramps up. But we're making more money, so the money is increasing faster than the goods are increasing. So we're making all this money, we're buying these goods, it puts upward pressure on prices. So again, too many dollars chasing too few goods, that causes rising prices. So, and that causes inflation. And you don't want inflation. I mean, basically, a small amount of inflation is good, but you don't want a high amount of inflation, like double-digit inflation. So when we have the situation where we're worried about inflation increasing because the economy is expanding too much, the government wants to ratchet that down a little bit. They want to decrease the growth of the economy. How do they do that? Well, through monetary policy, what they'll do is they'll raise interest rates. The way they raise interest rates, when they say they're raising interest rates, what they're actually doing is they are taking money out of the economy. Okay, so if they're going to raise interest rates, then they would be they're going to be selling bonds on the open market. So when they sell bonds, their money's coming back into the Federal Reserve. It's getting out of the economy. So when they say that they're raising interest rates, the way they make that happen is they actually sell bonds in the open market. So when they sell bonds, people are buying them, and so that takes money out of the economy. That decreases the money supply. All right, so just to repeat that, to raise interest rates, they sell bonds. So what happens when interest rates go up? That makes the economy contract. So when you think about interest rates going up, think about it from a company's perspective, not from us as personal investors. When interest rates go up, it makes the cost of capital go up, right? So it means that it's more expensive for companies to obtain money for expansions. So if the interest rates go up, it's going to contract the economy because companies, the cost of capital has increased for companies, so they won't expand as much. They might lay off people. It makes the economy contract. So that's on the one end. So what if we're in the other end? What if the economy is contracting? Interest rates are low. We've got GDP is contracting. Unemployment is increasing. People are losing jobs. So how can we stimulate growth? Well, stimulate growth by lowering the interest rates. So if you lower the interest rates, that's going to make money cheaper for companies, so they will expand. So what they do then is they go into the open market, and the Federal Reserve buys bonds. When they buy bonds, that puts money back into the system. And so that's in a nutshell how the Fed raising and lowering interest rates makes the economy contract or expand. Well, if it's expanding too much, it can make it contract. If we're down into a recession, if it's contracting, then lowering interest rates can make it expand. But economics is more of an art than a science. So they don't really know how much should they raise interest rates or how much should they lower interest rates. For example, the last recession that we were in, the Great Recession, 2007 to 2009, they kept lowering interest rates. They had interest rates effectively down to zero, and we were still in this recession. Well, that's because, and so you might ask why. Well, the reason is that there's a lot of other factors in place. Another factor is consumer confidence. If interest rates are low, it really doesn't matter. If companies don't have the confidence that people will buy their goods, then they're not going to expand. And so that was one of the issues, was consumer confidence was low. People didn't have jobs. There was really no confidence of the economy rebounding. So lowering interest rates really wasn't helping. It took a long time for us to get out of that last recession. That was one of the factors. But the point I'm making is it's a moving target, and there's a lot of other factors that come into play. So it's hard for it's hard to, that's why we don't have this steady line, because there's so many different factors. It's an art, it's not an exact science. Okay, so monetary policy is the manipulation of interest rates to try to smooth out the economy. Fiscal policy is the government using taxes and spending to try to stimulate the economy. So if you want to expand the economy and you're using fiscal policy, so if we're in a recession, what do? Well, you use taxes and spending, meaning if you want the economy to expand, you lower taxes and or increase spending. So the government could, like if you look at President Trump, for example, he lowered taxes when he first came into office. He lowered the corporate tax rate and he lowered the personal tax rate. That was one of the reasons why the economy expanded under Trump. And also companies, the stock market really had what they called a Trump bump after the election, because if you lower taxes, what does that mean? It means we all get a raise. It means our expenses are cut, we're getting a raise. It means companies have lower expenses, it means it increases their profits. That caused the stock market to go up. So getting back to any presidential administration, if they lower taxes, that's going to stimulate the economy. If they increase spending, like with Biden, for example, I think Trump was talking about infrastructure spending, but nothing really happened during the Trump administration as far as infrastructure spending. But that's one of the key things with the Biden administration is this increase in infrastructure spending, because our roads and our bridges are getting old and outdated. And so that's an example of increased spending that will stimulate the economy, because it creates jobs and so forth. So what if you're on the other end? What if they think that the economy is expanding too fast and they want to contract the economy? Well, then using fiscal policy, you would raise taxes and you would decrease spending. Okay, so that's fiscal versus monetary policy, trying to smooth out the economy. All right, so as I mentioned on the quiz, make sure you know the difference between the two and can explain those. And then also let's talk about inflation versus deflation. So I mentioned inflation is rising prices, too many dollars chasing too few goods. One of the economic indicators that they look at, that we look at, is called the Consumer Price Index. And so they want the consumer, that's basically a measure of inflation. And so if they expect the Consumer Price Index to increase by a certain amount, but if it's higher than expected, that could mean we've got some issues with inflation. So inflation is rising prices, deflation is decreasing prices. When we're in a recession, prices generally go down. We have negative gross domestic product. So if you recall from Econ 211, 212, 255, whichever courses you took, gross domestic product is how much we produce. All of the goods and services produced in this country is GDP. So we don't look at the total number of GDP, we look at the GDP growth rate. So we like to have GDP growth of around 3%. That's considered healthy and normal, 3% GDP. So it's a circular model. In other words, what I mean by that is everything we produce equals our income. So GDP equals income. And so if we have GDP growth of 3%, that means our income is increasing by 3%. So if we have deflation, GDP is decreasing. If you see a question, or if somebody asks you about inflation or deflation, inflation versus deflation, or if you see a question on the final exam relating to inflation versus deflation, asking you which is worse, actually deflation is worse than inflation. So you might say, well, why would deflation be worse than inflation? If deflation means lower prices, isn't that better for us because things are cheaper? But it's not, because deflation also means lower income. Less GDP means lower income. And deflation means that your salary might be less. because a lot of people who have government jobs, government pensions, and just jobs in the private sector, they have these cost of living increases that are tied to the consumer price index, tied to inflation. So if inflation is 3%, they'll get a cost of living increase of 3%. Well, if you have deflation, let's say deflation is 3%, theoretically, if they want to do this, you could actually have a cost of living decrease. Your pension could be lower, or you could be making less income, lower wages. So that's why deflation is considered to be worse than inflation. So interestingly, this is July 2021, and I was just reading an article. Social Security, they get cost of living increases every year based on the consumer price index. Now, when we had deflation, they didn't lower the Social Security payments, but they do when we had periods during the recession when we really didn't have any inflation at all. There were no cost of living adjustments. So they're speculating that this year, at the end of 2021, people might get a 6% increase in their Social Security benefits because we have higher inflation for the first time in a long time. And that's like the biggest increase in decades. So that's kind of an interesting side note. Okay, so let's kind of refresh what we've been talking about: the economy, inflation and deflation. Now I'm going to talk about fiscal and monetary policy. Now I'm going to talk about some of the economic indicators. So how do you try to figure out what's happening in the economy, and how does that translate to the markets? And this kind of ties back into the first part of your portfolio project, talking about the economy and the big picture. So make sure you look at that synopsis pursuant to that project, if you haven't already, after you watch this. So we have these economic indicators. And look in the book, they talk about leading indicators and lagging indicators and so forth. So like an example of a leading indicator typically is GDP. Leading indicators tell you what's going to happen next, what's going to happen in the future for the economy. Lagging indicators are going to tell you what's already happened. So like the unemployment rate is considered a lagging indicator because the unemployment rate is given once a month. I think it's the first Friday of each month. And so if the unemployment rate goes down, then we know that the economy probably has had a little downturn in the past. If it goes up, we know that the economy has had an upturn. An example of a leading indicator would be like orders for manufacturing, new orders for manufacturing goods. Let's see. Housing starts would be an example of a leading indicator, because if people if there's more houses being built, that's a sign that the economy is going to do well in the future. That means people are going to be buying more durable goods and so forth. So just make sure you read about these different indicators. So we look at these indicators to see, to try to gauge how the economy is doing, and then also to try to gauge how, as an investor, how the market's going to do, because if the economy is doing well, then the markets should do well. And also the stock market in general, this is kind of interesting. The market is also an indicator. It's a leading indicator for the economy because the market is forward thinking. So anyway, one of the ways when you think about these economic indicators, a lot of times the number isn't really important, but what's more important is what the economists think the number is going to be and what the actual number is. So as an investor, this is what's important. So what I mean is, if let's say that they think the economists think the unemployment rate is going to be 5.6%, okay, and the unemployment rate actually comes in at 5.2%. Well, it was lower than expected. So it's good news. It's an upside surprise. That'll make the market go up. Conversely, if they think it's going to be 5.6% and it ends up being 6%, then that's bad news and the market will go down. So the way to think about all these indicators as an investor is you have to think about, is that is the number going to be better than what the analysts think? And if the number is going to be better than what the analysts think it is, then you're going to see the market go up. Now, one of the indicators that's mentioned in the slides and also in the book that's very important is the Consumer Sentiment Index. This is really interesting. The Michigan Sentiment Survey is a consumer sentiment index. That's just a survey done by the University of Michigan once a month. They ask people basically what their thoughts are on the economy, how they think what their confidence is about the economy, about them having jobs and so forth. So that usually moves the market. If the Michigan sentiment number is higher than expected, then the market will go up. Because if people are positive about the economy, what does that mean? It means they're going to spend money, right? So that's real interesting. And so you can look at that Michigan Sentiment Index is pretty interesting. During around 100, if it's 100 or over 100, that's usually really good. During positive times, it's in the 90s, hundreds. During expansions, during recessions, it can be down around 60, 70. But again, with the Michigan Sentiment Index, the number isn't as important as, do they beat what the estimate's going to be, or is it lower than what the estimate's going to be? So that's one of the more interesting ones. And you would think that a survey really wouldn't be that important, but it actually is a pretty important indicator, and like I said, does move the market. Another one that's interesting to look at is every Thursday, there are new job claims and continuing job claims for unemployment. And so that's always in the news. What are the new unemployment claims and what are the continuing claims? And so, for example, if they think that the new unemployment claims are going to be 200,000 and it ends up to be 150,000, then that's good news, and that should help the market. And so anyway, you can look at some of these indicators, and for the report, I would look at the CPI would be a good one to look at, the Consumer Price Index, that's inflation. And then for some of your companies, you can look at some of these indicators that would be relevant for your company. For all of the companies, of course, taking a look at the Michigan Sentiment Report, I would say the Michigan Sentiment Report, the Consumer Price Index, and the unemployment rate. Just seeing where those three are could give you an idea of where the economy is. Then you can pick some other indicators that might be specific to your particular company. By that, I mean, let's say you have a home builder. Let's say you have Lennar or KB Homes or Toll Brothers. Those are home builders. Well, then obviously housing starts, the interest rate, that's going to affect home builders. So that's an example. Would be one example of a company that would be where those particular indicators would matter more. All right. So anyway, the indicators are interesting to look at, and what I do, and if you want to follow the market after this class, CNBC has a really good app. I have that on my phone, and you'll get the news throughout the day, but they always, in the morning, all of these economic reports come out before the market opens, and it allows you to follow these big economic indicators like job claims, CPI index, Michigan sentiment, and the unemployment rate. It'ose are the big ones, and so you can follow those. You can also go to Google and just Google economic calendar, and it'll bring you to Yahoo, for example. You can do economic calendar Yahoo on Google, and it'll show you what the economic calendar is, what's reported each week and so forth. And it'll tell you what they think the number is going to be and then what the number actually was. So anyway, so that's kind of there's just a general overview of these economic indicators. And so you can see why I said that economics is more of an art than a science, because there's so much of these, there's so much out, it's such a moving target. There's so much information, so many different things. The last thing I wanted to say was, for example, let's say sometimes when there's good economic news and you would think, oh, well, that's going to make the market go up, the market actually goes down. So here's an example. In the springtime, when we were coming out of the whole COVID mess, we were getting these really good economic reports, like the job claims were way down, much lower than expected. And so sometimes good news is bad news. And so you would have these good reports and you would think, oh, well, the market's probably going to be up today. The market would actually be down. Why would it be down? Because they were worried about inflation. So they figured, well, if the economy is rebounding and there's all this good news, then that means the Feds might raise interest rates, which means that it's going to be, the cost of capital is going to go up for companies. It's going to reduce their profits, and we're going to have inflation, rising prices. So that all means lower profits. So that would make the market go down. So, you know, there's so many themes in this class that all come back to, you can't time the market. You just buy and hold, because even though we have all this information at our disposal, it doesn't, you still really can't predict what's going to happen. Okay, so I think that's about all I had to say for this chapter. And just make sure that you read the book, read the PowerPoint slides in addition to this before taking the quiz. Take care.